Our central expectation for 2017 is for positive growth, with the election of Donald Trump likely to lead to some stimulative measures in the US, and that should have a flow through elsewhere. In Europe and Japan, though, we still expect to see deflationary impetus and low interest rates for a longer period to come. However, there's a lot of uncertainty over the global economy, and in particular the exact direction of policy that the United States will take and how that will impact the rest of the world. Some of the key implications of that outlook are that you will likely to have higher interest rates in the US gradually rising from their current level, and also increasing inflation. That's especially given the higher commodity prices we're currently seeing as well. So that's likely to be more positive for inflation-linked assets and assets that are linked to underlying interest rates, so floating rate assets, but it's likely to be less favourable for fixed coupon bonds such as government bonds and investment grade bonds. So it's important to have a portfolio that is diversified and is resilient to a wide range of different scenarios that might play out. We also don't know what's going to happen in China. Our view is that over the coming year, China should be relatively stable ahead of the politically important Party Congress towards the end of the year. But there are troubles further down the line that need to be addressed. So having a diversified portfolio is key. I think some of the important assets going forward, we like infrastructure assets because of the inflation-linked aspect, the reliable cash flows we get from those, and as inflation ticks up, and we're not expecting it to go very high, that should be supportive. We also like floating rate bonds such as loans or such as asset-backed securities over fixed rates such as government bonds or investment grade bonds are offering pretty low yields. And also we're favouring emerging market economies. We think that there's an increasingly favourable tailwind for emerging market economies coming from a pretty poor last few years, and with rising commodity prices, relatively low debt levels in emerging market economies, we think that's favourable for emerging market bonds. So there's a few different areas that we think are attractive.